Look at question 4, page 110, same set. Right, so this is what the examiner asks on variant. Okay, the first part is for commodity 3. What is the sales price operational and the sales price planning variant? And then B, using the data provided for commodities 1, 2, and 3, calculate the total sales mix and sales quantity variant. Now, so you have a 15 marks requirement just to work out price planning operational for commodity 3, and then this is mix and yield. You just need the table and then fill in the blank, and that's 11 marks. Okay. Now then, part C, briefly discuss the performance of the business, in particular that of the sales manager for the quarter ended 31st May 2013. Now it says that Block operates an absorption costing system and sells 3 types of product: commodity 1, commodity 2, and commodity 3. Now, like other competitors operating in the same market, Block is struggling to maintain revenues and profits in face of the economic recession which has engulfed in the country over the last 2 years. Sales prices fluctuate in the market in which Block operates. Consequently, at the beginning of each quarter, a market specialist who works on a consultancy basis for Block sets a budgeted sales price for each product for the quarter based on his expectations of the market. This then becomes the standard selling price for the quarter. The sales department itself is run by the company's sales manager, who negotiates the actual selling price with customers. Now, the following budgeted figures are available for quarter ended 31st May 2013. So now to give you commodity 1, 2, and 3, the budgeted production and sales, budgeted the standard selling price, the standard variable cost per unit. Now, Block uses absorption costing. The fixed production overheads are absorbed on the basis of direct machine hours, and the budgeted cost of these for the quarter ended 31st May 2013 was $174,400. Commodity 1, 2, 3 uses 0.2 hours, 0.6 and 0.8 of machine time respectively. Now, the following data shows the actual sales prices and volume achieved for each product by Block for quarter ended 31st May 2013, as well as the average market prices per unit. So all the 3 products given, then it says the following variances have already been correctly calculated for commodity 1 and commodity 2. So the sales price operational, and then the sales price planning variant. Okay. Now I find that if you look at that, really you don't need that. Okay. I don't know why examiner wants to tell you. Probably she helped you to check the answer. Maybe you don't know how to do price operational, so you can check commodity 1. If the numbers are the same, then you use it for commodity 3. Okay. But I don't think you need that. Okay. Now, so the first thing you're going to do now, A, what's your price operational variant? Now, so I'll go back and explain a bit again, right? Now, when we do planning operational variant, we always take the standard and the actual, and we break up into another standard, right? So there will be original and revised. Okay? Now, usually when you look at a variant, your price and quantity variant is part of the total variant. Now, example, if you look at your material variant, now you always have your material cost variant made up of usage and price. Am I right? Now, that's why you have your standard price, standard quantity, actual price, actual quantity. Then you break up another standard whereby this is original, this is revised. And then you bring this to the middle, you pull this to the middle, right now, okay? Pull this here, bring this here, pull this here. Now, so you created one more column and one more column for planning operational. Agree, okay? Now that's because we are looking at the same variant. They all belong to cost variant. That's why they will all be together. Okay? Now what variant that they're asking now? Selling price, right? Now selling price, do you still have anything within selling price, or the selling price is already one variant by itself? Is selling price like material variant got one pair one? Got price and quantity? Got selling price? Don't have it. Because selling price is standalone. Selling price variant and sales volume variant are different variances. They don't belong to the same category. Okay? Now because selling price variant is already a standalone variant, okay? Now you give me the formula for selling price variant. Yeah, standard selling price, and then actual quantity, then actual selling price and actual quantity. So the only thing you can do now for planning operation is what? Is this standard selling price, you made it into a revised selling price, because end of the day the AQ is the same, correct? Now this will give rise to your price planning and price operational variant. Okay? Now you don't have other choice, right? That's the only thing you can do. Okay? Now so you do that for me now. I've given you the formula. You just fill in the blank. Okay? So write again the proper one and then fill in the blank. Standard selling price original, actual quantity, Okay, so the standard selling price for commodity 3 is 41.6, right? And the actual selling price is 40.4. So the actual quantity is 25,006. So what revised price you have? Well, the revised is the price that if you know that the actual is going to be like that, then the standard you use, what would it be? So chances is, if you know the price is going to be like that, then you would have used an average price. So that's the only thing I can see there. What else can you do, right? You think and see, what else can I do? There's no other information you tell me about what you anticipate about the future, if it's going to be a more realistic estimation. So the only thing I can see now is your average market price. So the average market price will be 39.1. So one zero 1064. $64,000. That's your planning variant. So the price has been lower, right? So the variant is adverse. Okay. So 40.4 times 25.6 is 1034. This is your operational variant, and your price is much higher, so it's 33,280. Okay, right, that's it. Simple amount. Okay, B. Now, they want you to work out price, sales mix and sales quantity variant, which of course mix and quantity become volume. Now, you know this is mix and yield. The only difference is they apply to sales. Okay. Now, so you need 3 products that you sell. So commodity 1, 2, and 3. The total. Okay, what's the formula again? Standard what? Standard? Standard what? Standard quantity, standard mix, actual quantity, actual mix. And then the middle one is what? Is actual quantity, standard mix. What's the fourth one? Standard price. Okay. You fill in the standard price first. See what amount you use. Oh yeah. Really I must say no water. Very strange. Doesn't make sense. I see everywhere flood, then they say no water in the river. I don't know what they mean. There must be something behind that. Very strange. Phải đi cày tài lô. After 你们在等什么？ In the exam no one do for you, you know. 呢個犀利，呢個唔可以做啊！路上邊唔可以做，下邊啊唔可以俾我鬧啊！唔啱啊！我都冇睇到啊！唔係喎，你好想我鬧佢咩？好衰啊你！朋友嚟呢個，你估我係咯，出埋你啊！哎呦，真係。Hello, standard price. What do you use to calculate sales volume variance? Well, now you don't know what I'm asking. What do you use to calculate sales volume variance? What's the formula for sales volume variance? Well, you suddenly don't know sales volume variance. What's the formula? You already say the sales price variance and the sales volume variance are not the same. How can you take back standard selling price? It's not price, right? It should be what? Huh? It should be what? Yes, should be profit. Your sales volume variance measures the difference in profit or the difference in the contribution, depending on whether you're using AC or MC. So if you don't remember that, your whole answer all wrong already. Oh, okay, very scary. Now, so you must calculate the standard profit. Working one. Okay, what's your standard profit? The standard selling price is 30, 35, 41.6. Standard variable production cost is 18, 28.4, 26.4. Then what else you minus? The standard fixed production cost. Okay, how much is the standard fixed production cost? Okay, get me this amount. Then you get the standard profit. They say already, they absorb overhead using machine hours. You must take that into account. Thế à? Nhưng mà thấy không? Chuyển vừa nó xí, đi được ra. Còn mà đây chạy thị đeo tôi là đó. Macam ini mana boleh how to go exam like that? So basic things you all not sure like that. What is it you're so scared? You must work out your OAR, right? That's the first thing you must do. Right? You don't know the rate, how to calculate the overhead. The rate is 174,400 divide by the machine hour lah. The machine hour you calculate what? 30,000 times 0.2 plus 28,000 times 0.6 plus 26,000 times 0.8. you get 43,006. So 1744, you divide back, it should be 4. 啱咗一半. Okay? But you have to divide it, so you have to multiply back with the machine hour. This is per hour, man. It's not per unit. So you forgot to multiply back with the hour. So 4 times 0.2, 0.8. 4 times 0.6 is 2.4. 4 times 0.8 is 3.2. So my profit will be 11.2 per unit. 4.2 per unit and 12 per unit. Now that goes up to 11.2, 4.2, 12. Okay? Right. The rest all very easy here. AQAM is the actual. The actual is what? 29, 8, 34, 256. And the total of all the three is 85,008. Am I right? And you want the actual quantity, but go back into the standard mix. Now the standard mix is the budget lah, correct not? The budget is 30, 28, 26. 30, 28, 26 in total is 84. That means 30 out of 84 times 858. So it's 30643. 30, 28 is 2860. This one I take the balancing. So 26557. Now the standard quantity, standard mix. Now this is your sales. The standard must be the budget, which is 30, 28, 26, 84. Now by the time you have all the 9 numbers fill in, you actually are very, very close to getting all the answer. So you just need to find one, 2 times 4, 2, 3 times 4. So 1, 2 times 4 is your quantity variant, mix variant. Right. 30,000 minus 30643 times 11.2. 7201.6. Is that good or not good? Well, you sell more is good, right? So favorable. Now if your quantity is favorable, then it will be favorable all the way already, correct? 28,6 times 4.2. Favorable. 26, 12. Favorable as well. Now the total variant will be 16,645.6 favorable. Okay, mixed variant wise, 30,643, 298. So you get 9,441.6. Well, you sell lesser, so this is adverse. Two 286,304. So you sell more, this is favorable. 26577. This is less, so adverse as well. 13656 Fs. Actually, if you combine, you're going to get a sales volume variant of 3040 in total. Now they don't need you to find the sales volume, okay? So you're just asking for quantity and mix. Now actually, if you see this calculation right here, it's so simple, okay? You have 11 marks. You look at the examiner's answer, you will find probably it's a bit messy, okay? Because I prefer to use a table to solve it, which is always easiest and you won't make mistakes. As long as you follow the steps, okay? Alright, now I don't want to do part C so that I save more time. You just got to read up the answers on how to discuss the performance, okay? Now we just look at one more question, okay? Look at question 3. Okay, question 3. Now this is a question of, you can say is target costing plus life cycle combined, okay, which is a bit of everything, okay. Now the requirement here in part A, they want you to recalculate the estimated life cycle cost for the webcam, taking into account point 1 to point 3. That is 12 marks already, okay? And then B, they ask you to talk about what is market skimming strategy. What is market skimming? When you start, you sell high or you sell low? Market skimming. You sell high or you sell? Yes, you sell high. Skimming is you sell very high and then you gradually reduce the price, okay? So there's another theory that they ask you to explain. That's on pricing already, okay? Okay, Camco manufactures webcam, devices which can provide live video and audio stream via personal computers. It has recently been suffering from liquidity problem and hopes that these will be eased by the launch of its new webcam, which has revolutionary audio sound and visual quality. The webcam is expected to have a product life cycle of 2 years. Market research has already been carried out to establish the target selling price and projected lifetime sales volume for the product. The cost estimates have also been prepared, and based on the current proposed product specification, CAM uses life cycle costing to work out the target cost for its product, believing it to be more accurate to use the average cost across the whole lifetime of a product rather than potentially different costs for different years. You are provided with the following relevant information. Now, projected lifetime sales volume is 50,000 units. Target selling price is 200. Target profit margin is 35% of selling price, which is 70. Target cost is 130. The estimated lifetime cost per unit is 160. See the note below for the detailed breakdown. Now, how they get 160? They say the material cost is $40, labor is 26, machine is 21, quality control is 10, rework is 3. The non-manufacturing cost has product development 25, marketing cost 35. So that's how the lifetime cost of 160 is derived. Okay, now they say the average market price for the webcam is only $150. Well, that means your price is much higher, okay? Now the company needs to close the cost gap of $30, okay? Because the actual estimated cost is 160, right? But the target cost is 130, so you need to close the cost gap of 30. And the following information has been identified as relevant. Okay, number 1, direct material cost. Now all the parts currently proposed for the webcam are bespoke part. Bespoke means tailor-made. Tailor-made. Okay. However, most of these can actually be replaced with standard parts, costing 55% lesser. But 3 of the parts which currently account for 20% of the estimated direct material cost cannot be replaced, although an alternative supplier charging 10% less has been sourced for these parts. Direct labor costs. The webcam uses 45 minutes of direct labor, which costs 34.67 per hour. The use of more standard parts, however, will mean that while the first unit will still be expected to take 45 minutes, there will now be an expected rate of learning of 90%, where B is negative 0.152. And this will end after the first 100 units have been completed. And the rework cost. Now this is the average rework cost of the webcam, and is based on the estimate of 15% of the webcam requiring the rework at the cost of $20 per rework. With the use of more standard part, the rate of rework will fall to 10% and the cost of rework will fall to $18. So if you look at it, I think it's a bit of everything. And this appeared to me, if you ask me, a flexible budget also can. Because you are just adjusting the cost only. They just tell you this is the amount and then adjust back. Although she did mention its life cycle, she did mention its target price. The target price also I don't need you to do. She gave you everything. You see, target price, target cost, all she gave you. Okay, so that's why I don't see this as any very unusual question. Okay, it's just like budgeting to me. Okay, now so what they want you to do now in part A is they want you to calculate again. That means when you calculate again, you expect your cost will change, your material cost will change, your labor cost will change, then your rework cost will change. 3 costs is going to change, the rest will remain. So after you calculate the 3 amount, will it be 130? Now please do that for me. Now I just want you to do 2 things for me. Just work out for me the new material cost, the rework cost. I presume that learning curve you very good at it. You don't need to do that one. Okay, so just do material cost, rework cost. That's all. Okay, so you can get the amount, then it should be good enough. Then your 12 marks will be in your hand. Then the 12 marks will be in your hand. Okay. So we have your direct material cost. Now, this direct material cost, now they say 20% you cannot replace. So the existing cost is 40, correct? No? So replace with standard parts. That means the 80%. No? Now after you replace, it will cost 55% lesser. That means it's 0.45. So 32 times 0.45 is 14.4. Now the non-replaceable part will be the balance 20. Although you can't replace, you still can get another supplier willing to offer discount. So your material cost is 21.6. Okay. Labor. Now this time we have to show again the life cycle cost. So the life cycle is based on if you produce 50,000 units. So if you're producing 50,000 units, then you need to work out what labor cost you're going to pay from the first unit right up to 50,000. Okay. So the labor cost for the first 100 unit, labor cost for the next 499 unit. Right now? Because the first 100 got learning. After that, no learning. Okay? Then you calculate the total and you average out. So the first 100 unit, you're going to use the formula y equals to ax power of b. So if y equals to ax power of b, y is ax power of b. Now I just straight away show the amount here. Okay, you in the exam you show working lah. Now you should know the thing very well now because the amount all given. Okay. Now they tell you 45 minutes times divide by 60 is hour lah, times 34.67. So your rate is about $26 an hour. Your rate is $26 an hour. Okay, again, so $26 a unit. All right. So 34.67 times 45 divided by 60. The cost is 26 per unit, which is what they show here lah. 26 maha. Okay. Now, I don't need to use time lah. I can straight away use cost because I want cost only, okay? So my cost will be 26 times 100 power of negative 0.152 multiplied by 100. 26 times 100 power of negative 0.152 is about 12.9114. 12.9114 times 100. The cost is 1291.14. Okay. Okay, then the cost for the next 499, I must take the labor cost for 100 minus labor cost for 99. Right. So the labor cost for 100 is 1291.14. The labor cost for 99 is y. So I replace 26 times 99 power of negative 0.152. So that's 12.9311. 12.9311 times 99. So it will give me 1280.18. So it comes to about 10.96 per unit. So if it's 10.96 per unit, 499 will be 546904. So the total cost is 548,195.14. So if you take 548,195.14, you divide it by 50,000 units, you're going to get 10.9639. Okay? So the cost per unit is 10.96. Now it's because the learning is very short. Because you are looking at 50,000 units. The learning lasts until 100. After that, you will stay at 10.96. That's why the average effect into it is very small. So there's a reason why after you average it, hey, how come still the same as 10.96? Actually, it's not 10.96. We didn't round the figure. Because if you continue the number, the amount is quite big. Okay, but I just round it to 10.96. Okay, now, so that's my labor cost. Okay, the machine cost is 21. The quality rework, quality control is 10. Rework. So how much you gonna pay for rework working for? Now, see, in terms of the reworking, now they mentioned that right now is based on 15%, that the cost is 20. But if you use the standard component, it will only be 10% and the cost is 18. That means the rework cost will only be 10% of the 50,000, right? And then each rework will only cost 18. But this is total, right? You average out by dividing with 50,000 units. Now that comes to only 1.8 per unit. Okay, all right, so bring the 1.8. Okay, the two more items will be your product development cost, 25, and then your marketing cost, 35. So the new estimated lifetime cost per unit is 125.36, which you have achieved or eliminated the cost gap. Okay. Now, part B, they ask you about skimming. Now, look at the requirement and see what they want. Okay, they say, explain what is the meaning of market skimming strategy. So there's one requirement already. And then discuss, as far as information allows, whether the strategy may be more appropriate for Camco than charging one price throughout the entire life cycle. Okay, now I think if you look at products like camera, you normally don't sell at one price and then stay throughout, right? Because at the end, your camera become outdated. Then who will still pay the same price, right? So chances is people will not do it. Okay, now then if you start at very low price, you will invite price war, because other people want to fight with you, then they will sell very low also, because you start with one price, chances is the price is average. Okay, now so I just put out some point that you can include this as the answer. Now first you explain the meaning of skimming pricing. Okay, that means start high price, then go down. Okay. Number two, they talk about suitability for Camco. Now, why do you find that is suitable? Now, of course, number one is the product nature. Okay. Now, product nature is technological, so it's suitable to use skimming. Because why is it suitable to use skimming if product is technological? Now there's a few points that we can bring in here. Number one, if you have new technology, you can demand for the price because you have something people don't have. Okay, so we call this as the technology age, that you are having a new tech that others don't, so you can demand higher price. Now number two, another point that we know when it comes to technology, at the beginning, because technology is new, the customers, they are not so price or demand elastic. They value the technology, so they don't mind paying for it, right? Now, so usually at the beginning of the technology, the users want it, so they are less price sensitive. The demand is inelastic because they appreciate the technology. They know that this is something good, so that they want it. They don't mind paying for it. Okay. Now, number 3, usually because we need to get back the cash to cover the large investment when you are developing the product. Okay. Now, if you set only one price, that means at average price, which means it's likely to be lower than the initial launching price. Okay. So if your initial price is, let's say, 300, then you want to reduce it to 150. Probably now you sell 200 in between. Okay. Now, if you're going to set an average price which tends to be lower at the start, then you might invite price war from other players. Then this product profitability will be affected very soon after you launched it. Okay. Now, another point that we can say is technology is something very uncertain. You can come up with a technology and say that you expect that yes, the technology may last 2 years, 3 years, but if all of a sudden there is a better technology come out, you can expect suddenly the sales just drop to 0 because you don't have a technology, you don't have a product that is appealing anymore. So you always must cater for the risk that this technology can go obsolete. So if you sell an average price, you have not even recovered back the money, then you cannot sell the product. So which is very risky for the business. Okay. Now the technology is subject to high risk of obsolescence. So if a new technology is invented, there can be a sudden steep drop in demand. So it's actually safer to camp to sell high price at the beginning. Okay, right. So these are some of those points. So it's quite common sense also. They're just asking you about pricing, and then apply that into the product to justify why that this pricing is suitable. Okay. All right. So that's it. Now I'll show you a few questions today that link with the new areas we covered. Okay. Right. We will see one more tonight on throughput accounting. Okay. So take a break for dinner and continue later.